for now, all of this is being taken well by the street. 19,760 is where we have opened for the Nifty. The advanced decline ratio, that is what is really impressive, and that's telling you that the rally in the broader market is really continuing for now. So pull up the small cap index, 7th day on the trot. That index has been inching higher. The mid-cap index too should be holding up well in the green. Sectorally speaking, let's watch out for what's doing well, because banks have again had a bit of a tempered start with a gain of around 0.2%. It's real estate pack which is actually building onto gains. Pull up a Brigade, an Oberoi, a Lodha. All of these stocks are doing well for themselves. You also have some of the metal names like Jindal Stainless, which are perking up as we speak. In terms of the newsmakers, let's watch out for what Endurance Tech is doing, because that was going to open up with a bit of a green tick. NBCC was the other one that we were watching out for. And then, of course, Medanta, L&T, MCX. These were some of the other names. Nazara Tech is also in focus on account of that tax notice that they have got. Let's see if the stock is reacting to that or not. On the losing side, ICICI Lombard is the one to watch out for, given the fact that they also have got a heavy notice at their hands. Bandhan Bank, watch out for that one because there was a lot of action on that. KSB Pumps had got some order wins, so that one is reacting positively. And Ujjivan Small Finance Bank, in the last half an hour of the trading session yesterday, that had suddenly spiked 9%, and that momentum really is continuing, Ajay. Another 3% rally coming in for Ujjivan.
In fact, there is an arbitrage there. Ujjivan Small Finance Bank, if you buy directly, you'll get the other one, the other entity actually much more cheaper. So that's the reason why yesterday, last hour of trade, there was some big HNI block which happened. But market is kind of stable, 120 points on the Bank Nifty. Let it settle down for a few minutes. But looking at the opening, Kunal, what is your opening trade?
So in terms of opening trade, I would go for HDFC Bank, another formidable large cap name which could actually make a decent comeback. The stock is at 1530, 1540 mark. It's very close towards a major support, something which it tested in 2022 and 21 as well. So that's one of the major reasons for picking a buy on HDFC Bank.
Nuresh, how does the market look to you? What is your opening trade?
So the market looks, the bias remains positive. Looking at a buy on dips on MCX closer to 1920, 1940 bank.
Okay, so that was about MCX. The continuing, the buy really continues on that one, and HDFC Bank is something as well, which which Kunal likes at this point of time. In terms of the market as well, it's holding up okay. Let's see what else is happening. HAL, of course, that stock is reacting to the stock split that has happened. So don't get worried about that sharp downtick that you see on the screen. That's on account of an adjustment that is likely to happen. Nuvama Wealth, since its opening, has been on the back foot. So we have seen a cut of around 5% there. Signature Global had seen the listing yesterday, was up almost 20%. Today it's cooling off a bit. So these are the big movers, and TVS Supply Chain too is coming up, apart from Cyient, which is seeing a decent amount of volumes right now. But let's listen into the opinion coming in from market veterans as well as our market experts as to where the markets are headed after the outperformance that we have seen versus the rest of the globe so far.
Our major themes going forward, and that's where we're very bullish on, is financials and discretionary consumption, and also affordable luxury kind of consumption that we're looking at. Discretionary is what we're looking at, and there again in say aspirational luxury. So obviously hospitality comes in a big way. Pure textiles move in here. There are shoe companies as such which come in, and obviously these are few sectors that are playing out for us.
Without labeling them as defensive or growth, I would say that bank today makes a lot of more sense, because whatever growth we are talking about in the economy, definitely it has to happen through the banking sector. I keep talking about IT as one of the sectors which I generally have a positive bias towards because of a simple fact that this is a very strong cash generating sector. And more importantly, this is a sector which also distributes a large part of the profit back to the shareholders. And hence, from let's say dividend yield or cash flow yield perspective, this is one of the better sectors to look at.
While the Indian consumer story is not lost to anybody, Indian consumer has been doing well for last couple of decades. You have a large middle class population where the dependency ratio is falling, per capita income is rising. So obviously Indian consumer story is not going anywhere.
See, at the end of the day, we give targets. Okay, I give some target of X, Y, Z. The target's not important. The important part is the direction. The important part is, are you invested?
And I think there's a strong case to be invested in India. You'll realize that whether you see globally, let's take it globally, India is probably the only market at lifetime highs. The index is not really showing the actual bullishness of the market. The reason is that if you see the two biggest components of the index, one is banking and second is IT, you'll find that actually they have muted performance. So if you really sort of adjust for that, you will find that the market is like way beyond. The Nifty is way beyond, because the components per se, the broader market is telling a different story.
So election results are announced in May. Let's say 6 months prior to that, that is November to May period of this 5 different Lok Sabha elections era. Markets have given you positive returns, 10 to 32%.
Yeah.
Right?
Mature
The
data, yeah.
best returns were in 1999 and 2009. Of course, every period has its own contextual nuances, but history is in favor of a pre-election rally, which is the period you will enter in another month and a half. And so far, if you go by the pre-poll surveys which have come in, last 15 days, we have seen about 3 pre-poll surveys. They are all pointing towards continuation of the current regime. If this sort of sentiment gets bolstered as you move closer to December, January, I foresee another leg of a rally.
Okay, not as enthusing definitely as the pre-open rates were indicating. It's at best a quiet start, but intriguing names out there. Look at Indiabulls Housing. That's one of the top movers within the F&O segment right now. About 0.7% I think is the move higher in the cash market, that is. There's Can Bank, which is again propping up today. Bank Nifty flat there, and Reliance just a very marginal uptick coming in there. Kunal, PSBs as a trend, if you were to really pick up anything?
Yeah, I would be bullish on PSBs, and I think the move is now coming back into those Tier 2 PSU banking stocks, the likes of Central Bank, Bank of Maharashtra, many of these other Tier 2 names, PSB, Punjab and Sindh Bank. Even that stock has shown good momentum for itself. So I would probably expect that we would get back into that same theme which we had a couple of weeks back for these PSU banking stocks, where the mid caps were doing pretty well for themselves and the large caps were just about playing more of a catch up.
Okay, Kunal, we'll chat with you later in the show. Thanks as always for joining in. Let's also welcome on board Vikas Khemani from Carnelian Asset Management on the show right now. Vikas, hi, good morning. Vikas, just wondering, with all the news points and data points coming in with regards to crude now again, getting back to 100-odd levels or at least in sight, we're 97 already. And the way the dollar index has been moving, does it spell at large bad news for us?
Surely, crude moving up is a sign of worry for sure, because it has a direct impact on the inflationary number, and which has a direct impact on the monetary policy. So some time ago, what we were expecting bit of a dovish stance by the regulator, by the central bankers, which might get halted, and we'll have to see what trajectory crude takes from a medium term to long term perspective. While it looks like that this probably is a short-term blip, but one can't say for sure. One has to see how it pans out. But this is definitely a point of worry, and one should sort of, especially from a short-term perspective.
Vikas, morning. Vikas, are you keeping some powder dry for some opportunistic plays if these global macros do provide a kind of a shake-off in the market? You may have identified ideas. We've seen your stock picking in the last few weeks. Are you keeping some powder dry to add on or spot new opportunities?
I think we have some amount of cash sitting with us. That more than a macro call, it is always a call on I think whenever we find ideas, and we've been recently little bit cautious given some amount of run up and the euphoria kind of situation in the market. But it's not that we're sitting on a lot of cash. We probably single digit 7-8% cash, and from there. We will deploy. Our investing style is more from a 3 to 5 years or maybe longer kind of perspective. So I don't see any change in our stance. We don't see crude taking a very long, high, sustainably high, remaining high, upwards of 90. So we think it will come back, but we will kind of keep taking view as and when how situation develops. But currently, as and when markets corrects, we kind of put in money because we are very convinced about structural story of India.
Because I was just going through your portfolio and I see a lot of these names like Aditya Birla Capital, 361, ICICI Securities. Are you betting big on the entire financialization theme?
I mean, we have been very bullish on the entire financial services themes, because it's a structural story, especially, the credit side. I mean, and India has a very, very, wide range of interesting stories to play, and financial services will be one of the biggest beneficiary as the economic growth comes. So we've been very bullish, and we've been, overweight for quite some time, and we continue to remain that.
Because asset management, I mean, you have worked very closely in that, and you are in that business. There are new wealth managers getting listed. There are two of them which have been doing okay in the market, and one of them which has got a kind of monopolistic or a very largish market share in the wealth management space in India is in your portfolio as well. Do you see the cyclicality of this business going down and now much more structural because of very heavy flows coming in from the retail towards financial markets?
So as Indian economy goes towards $5 trillion, and more, it is very natural that massive amount of wealth will get created, and as the wealth gets created, there will be need for wealth management platforms, asset management platform. So again, it is that part of the financial services business which structurally, is in a good upward trajectory. Of course, like any business, there will be medium-term, short-term cycles. They will always be around, but we remain quite positive in the entire financial services and in non-credit space. Advisory, wealth management platform, asset management platform, all those are interesting. Of course, you have to see business trends more. I mean, individual companies have to be studied, but generally speaking, to answer your comment, on asset management, wealth management platform, we are quite positive.
Vikas, where else do you find interest in the market whenever we do see some correction play out, given that you have kept some cash on the sidelines? Because what one has seen is in the last 1 year, the market has broadened itself. And, newer sectors are emerging as investable opportunities, right? I mean, everything from defense to railways to power and its ancillaries all moving up right now. You've got EMS names which are propping up. Anything from these themes that you find interesting?
I think very clearly, and we have spoken about this in the past, that India is seeing a very fairly wide width of the opportunities, right from banking to auto to manufacturing, IT services to, infrastructure space to consumption, within consumption, different places and new age companies. So it's the first time it has happened that all guns are firing. And when this kind of, situation come about, I always make this comment that one is spoiled for choice. Even if when markets are at this stage, you are able to find interesting ideas. And that is what the real beauty of the Indian markets. And more the depth, width is there and depth is there. Your bubble kind of situation is, sort of averted or delayed or prolonged. It can absorb large amount of money. It can create more wealth. So I see, India's story continue to remain very, very robust. And within that, you will always see many new and emerging opportunities coming about. What we can't see today, I'm telling you, more and more will come. And also what is happening is some of the old sectors, as you would have seen, India is staring at a power shortage in the next 4 or 5 years. So you are seeing even beginning to see the conventional energy kind of segments also coming back into interest. So, when this kind of economic growth happens, a lot of interesting opportunities are there. And all we as an asset managers have to look at risk reward, long term, and your own, of course, investment philosophy, what fits into that. And that's where you kind of buy an idea. It is not about, honestly speaking, big macro idea, but more about bottom up, good management, good business, which can give you sustainable risk adjusted returns.
Sure. Let's talk about some of those bottom-ups idea. I also see Senco Gold in your portfolio. Would you want to talk about the thesis and the rationale on it?
Look, again, I mean, I always stay away from commenting on stock-specific names, but it's a consumer discretionary space, very well managed company. Recently went public. We participated in IPO. We like the management, we like the business, and more importantly, I think valuations were reasonable when we bought. So risk reward was very, very favorable, and markets were not excited about the IPO, but we were very, very, very positive, looking at the overall opportunity space. And it has given great returns in a short period of time. We never expected this kind of return in such a short period of time, but markets had its own way of surprising both upside and downside. So we will remain invested in anything which we like from structural point of view.
Trimming your position or booking profit, you're holding on, and any other IPO names that you've liked recently where you saw value on the table?
I won't probably comment on again on a specific name, but generally we evaluate every opportunity, and only when we are convinced about risk reward of trade we invest.
There's a very big upgrade on L&T coming in today. That's also part of your portfolio. But I want to understand, your view on the way L&T is changing complexion. There was a buyback, their capital allocation call, and especially the overseas opportunities in hydrocarbon and new energy, which they are starting to get in a very major manner. Almost 30% of it is now new energy and hydrocarbons.
No, absolutely, Ajay. I think you got it right. That see, if India economic growth story has to happen, if India investment cycle has to happen, L&T is the flag bearer of that. You can't build India without L&T benefiting. India L&T is present across all segments, whether it is hydrocarbons to infrastructure to industrials to everything, residential, everything. It's kind of broadly defense everywhere. It is kind of positioned well, and all these cylinders are firing. And more importantly, as you rightly said, in last 5-7 years, management has worked hard in terms of getting their capital allocation right, focusing on ROC, and also they have created fabulous business in terms of IT services. So the company has got transformed, over last decade or so, and in the recent past, focus on capital allocation. And more importantly, I think the investment cycle in India and in Middle East, where L&T is very strong, is picking up in a big way. So it will remain beneficiary, according to us, in a foreseeable future. At least I see for next 3 to 5 years, nothing changing, negatively for the sector and company in specific. So our idea is to remain invested into structural ideas.
Sure. Okay. Great to then have you on the show today, Vikas. Thanks as always for joining in.
Pleasure. Thank you for having me.
Okay, let's move on. Let's just take stock of what the market as well is settled in at. It's really a nothing start once again. Hopefully, we actually see a move like yesterday wherein we managed to close in at the session highs. But for now, it's very quiet. It's Canara Bank, Reliance, which are seeing some dots of green. I can see Bajaj Auto, Apollo Hospitals, Axis Bank hold out. But a large part of the market continues to be beleaguered, be it in HDFC Bank or, for that matter, a large chunk of the heavyweights. Look at Bajaj Finance as well, for instance. That's down 0.7%. Eicher Motors, Asian Paints. The crude sensitives, of course, are having it tough today. But let's welcome on board Rajiv Lochan. He's the MD at Sundaram Finance, and try and figure out how their business is looking like. Rajiv, hi, good morning. Welcome to ET Now. Rajiv, just wanted to understand what's the macro environment for you right now, and perhaps you'd have a better lens about both the government's push on infrastructure and the kind of revival that is expected to kick in for the CV cycle.
Thanks for having us on the show. Much appreciated. I think medium term, the India story is looking quite good. Near term, I think we are off to a pretty good start as a sector for the financial year. Q2 tends to be a little bit slower, just given monsoons and the attendant complications that come with it. But to the specific questions around the M&HCV cycle, construction infra, I think all those are looking quite good at this point. The infrastructure push is steady and sustained for the long term. So all sort of asset classes under that, whether it is at the tipper end of the segment or excavators, backhoe loaders, and more sophisticated construction equipment, there's pretty robust demand. So much so that there's actually demand for these overseas as well, and that's something we're trying to tackle, where assets get bought here and get smuggled or shipped out overseas, which is a big risk issue that we're grappling with. But on the M&HCV side, through COVID, we've come to a bottom of the cycle, and now we are firmly in the lower end of the upcycle. And our sense is over the next 2 or 3 years, we should see sustained growth in the M&HCV space. Economic activity is tracking quite well. All the leading indicators we're looking at, diesel consumption, e-way bills, and so on and so forth, point to sustained and steady economic activity. And going into the festival season, which is always an auspicious time across the country, across different customer segments, we expect the optimism and confidence to continue through Q3 as well.
So you are so upbeat. I wanted to understand what is it that you hope to clock in terms of AUMs and disbursements, as well as what your target would be for FY24. Because even in the first quarter, which is seasonally weak, your numbers managed to beat the street estimates?
As a matter of practice, we've never given any guidance, and I prefer not to start a new tradition just now. I will just say that we prefer to ensure that we retain the market share that we think we rightfully deserve, and where we can extend it a little bit. Our focus tends to be on serving the customer segments as best as possible and ensuring that we are taking care of our people as best as possible. If you look at the long term, over long periods of time, we've grown between 15 and 20%, pretty much any metric you look at. And in a sense, that's the long-term aspiration for the company, to remain steady, consistent, marathon runner type of biorhythm that we would like to ensure, which has been our heritage, as I'm sure you're aware, and that's the heritage we would like to further as well.
Rajiv, you're one of the few NBFCs which are trading at 52-week high, by the way. So market is loving what you're doing. And that too at a time when almost half of your portfolio is at the troughing out phase of the cycle. I want to talk about where in the cycle is the rest of the half of the portfolios, cars, farm equipment, construction equipment, that part. Because some of your peers are clocking good numbers. What's the visibility there?
Yeah. Passenger cars, I think, is a long-term consumer story. I think as India moves towards being a middle-income country, I think the natural shift towards passenger car ownership is continuing. And we're seeing that quite systematically in the last few years. Coming out of COVID, we've seen sort of record numbers as far as passenger vehicles is concerned. The other trend I'm sure all of you are also tracking is the shift towards the higher segment cars, C and D segment cars, as well as utility vehicles, which again speaks to sort of the aspiration and affluence levels within the country. So our sense is passenger vehicles sees a steady, systematic kind of trend looking ahead the next few years. Tractor and farm equipment is a very interesting segment. Our own sense is the government is remarkably sharply focused on ensuring rural welfare and farm incomes more than double. I think the rural revolution 2.0 that is now underway is very real on the ground that we're seeing. Consequent to that, there's a fair bit of mechanization. So it's not just tractors where we're seeing steady and systematic growth. We're also seeing in farm equipment and broader mechanization of the agriculture space that's gaining traction. Interestingly, I think related allied agri segments like dairy and so forth are also seeing a fair bit of traction within the country. Today, we are the largest producer of dairy in the world, and I think we have a long runway there. So I feel tractor, farm equipment and related segments have a long runway for growth and prosperity. Construction equipment, like I mentioned earlier, I think this is a multi-year journey that the government has committed to and is very firmly implementing. And on the back of that, we are seeing across all the sub-asset classes pretty significant traction that's happening. I think metro construction, for example, in the metro areas is really peaking now. And that requires fairly sophisticated equipment, whether it is tunnel boring machines or other types of equipment to set up, pillars and so on and so forth, piles and so forth.
Sure.
So fair bit of traction, I'd say, on the infrastructure space as well.
Sure, fair bit of traction on the infrastructure space, Rajiv, but you have also forayed and looking at getting deeper into the affordable housing segment as well. Talk to me about what could be the mix in the overall pie, let's say 2 to 3 years from here on.
So our affordable housing foray happens out of our 100% subsidiary in Sundaram Home Finance. They have a judicious mix between housing, loans against property and construction finance. And a natural extension to that is the affordable housing segment. We tend to be relatively strong in the southern markets, particularly as you go deeper into the southern markets, tier 2, tier 3 towns, we tend to have a pretty strong presence. So affordable housing is very much one of the strategic drivers within our home finance subsidiary. And we see that also as having long-term legs, and that will steadily grow as a mix of our portfolio.
And could you also talk to me about what your outlook is on the cost of funds, how they are likely to move, and the NIMs on account of that?
Sure. I think it's a $1 trillion question. If someone could just give us a sense for how that is likely to pan out, I think that would be most helpful. Our own sense is the regulator is truly grappling with a very complicated challenge. As inflation spikes and cools off, they have to take a long-term view to how to contain that. At the same time, currency needs to be managed well. So our sense is looking ahead, unless there are some significant global forces. For example, the Fed or other central banks overseas significantly raising rates to cool inflation. Our sense is, the basis for further rate hikes is limited. And consequently, we think we've sort of reached the peak as far as the repo rate hikes are concerned. Our focus is very much being AAA rated on ensuring that we get the best cost of borrowing from a diversified set of lenders and transmit as best as possible. What we've seen through the last 2 or 3 years is widening of margins, certainly for us, but also for the system as a whole, largely because I think of the COVID accommodation that the regulator and the government provided. Subsequently, now as things have settled, we are back to pre-COVID margins, both in the system and certainly for us. And we think we'll now begin to operate in our long-term corridor of NIMs, which has typically been in the 4.5% to 5% kind of range. That's where we think in the medium term we will settle down in.
Okay, so 4.5% to 5% kind of NIM margin. And before I let you go, Rajiv, yesterday we were also discussing with IMD how the monsoons have started withdrawing. There's still a deficit of almost 6%, and it's been very patchy. Are you worried about the asset quality? Because there were some of the analysts and brokerage community who were talking about the stress that could come on the book on account of that.
No, I think that is very much monitorable and a key monitorable, I would argue. I think monsoons and the attendant complications that you characterize quite well are very real. In some places, we've seen a significant excess. Places like Punjab, Himachal have been ravaged by rains. Others are substantially lower. I think many segments of our customers have actually lost a crop in some places. So, it's a complicated situation, and we'll have to see how we work through that. Not just that, as we get into sort of election season across multiple states, I think typically what tends to happen is, some spending gets front-ended, but also payments get delayed, projects get rethought. So there is, over the next 6 to 9 months, I would argue, sufficient basis for us to remain watchful on payment delays, contractors delaying payments, working capital pressures, and as a result, tightly monitoring asset quality and ensuring that collections and recovery is on track. So it's not all hunky-dory. The medium-term story for India is certainly robust, but in the near term, as we navigate both geopolitical, macroeconomic, weather-related challenges and some of the regulatory challenges that our regulator is faced with, there will be near-term challenges for us to grapple. So I want to leave a very balanced picture for you guys.
Okay. Great to then have you on the show, Rajiv. Thanks as always for taking the time out.
Thanks for having us. Take care.
Okay, that's the word coming in from Sundaran Finance. Pretty bullish, but always caveated the near term. That stock has been doing well, as is the case with REC PFC. They were the big buzzers from yesterday, so we'll do exactly that. We're going to be chatting with Vivek Kumar Devanga and the CMD at REC, but after this very short break. Back with the market right here in ET now. While at an index level, we're just marginally soft right now. But I have to flag off some of the big movers that are holding up the index or whatever it's been doing, right? So it's a bit of a tug of war out there. Look at L&T. For a second consecutive day on the trot, that's one stock which has been powering ahead. It's another 1.6% move on the stock price. And by the way, it's hit a fresh all-time high, L&T, that of 3016 levels. And of course, this is in the backdrop of that massive upgrade coming in on L&T, quoting a target price of 3600 on this one on a 12-month basis. MCX, Crompton, these are the big movers today. Balrampur Chini is holding out well, and I don't know after how long you're actually seeing a minuscule move. And I say minuscule because there's been a lot of damage which has been done, so it's going to take a long while to undo all of that. But about 1.5% is the up move that you're seeing on Delta Corp too. But the one stock that has been buzzing a fair bit off late, REC. So let me welcome on board the CMD. We've got Vivek Kumar Devangan joining in on the show right now. Mr. Devangan, great to have you today on ET Now. Thank you so much for taking the time out. Now, firstly, you've signed many project-level MOUs, as we understand, and now this 55,000 crore rupees co-finance plan with PNB as well. What's the realistic visibility of disbursements that you foresee for both FY24 and 25?
Yeah, in fact, when we had organized this Green Finance Summit on the sideline of G20 event at Goa, we got a huge response from the renewable energy developers, technology providers, and the manufacturers, and we were able to sign MOUs worth 2,86,000 crore. And Government of India has also allowed us to diversify into infrastructure and logistics. That is another area where we are focusing, and government has allowed us that 30% of 33% of our loan book could be from infrastructure and logistics. So we are we are having collaboration with the number of financial institutions like PNB also, and SBI and other financial institutions. We are in discussion with other financial institutions because the asset size is going to be quite large, more than 30,000-40,000 crore. Then we need to collaborate with other financial institutions. As you are aware that our loan book has grown in last financial year to the extent of 13%, but in the current financial year in Q1 there was growth of about 20%. We would like to sustain this growth in asset under management, and we intend to touch the figure of 5 lakh crore in the current financial year. And although we were targeting that our asset under management will increase to about 10 lakh crore by the year 2030, but the kind of growth which is happening, there's huge demand of power, and the power sector is looking forward. So we hope that we'll be able to reach this asset under management of 10 lakh crore earlier than 2030, maybe in next 5 years. By 2028 we'll be able to achieve that figure.
Vivek, though that appears to be your medium to long term kind of ambition at the company, and also because of the government's renewed focus, what would be your near term composition of loan book? 2 to 3 year far out, what would be your composition of the loan book? Because we understand that the contribution from green would start going up. What internally is your target which you have set?
Right now, the share of conventional generation in our loan portfolio is about 40%, and distribution sector accounts for about 44%. And the share of renewable in our loan portfolio is about 7%. In near term, next 2 to 3 years, we hope that the share of renewable will increase substantially and share of conventional generation will come down, because not many conventional generation projects are coming. So we hope that renewable energy portfolio will increase from 7% to about 15 to 20% next 2 to 3 years, and we are targeting that this renewable energy portfolio will increase to about 30% by the year 2030. We are targeting tenfold increase in our renewable energy portfolio. Right now, our renewable energy portfolio stands at around 30,000 crore, and we intend to increase to about 3 lakh crore in next 7 years. But the kind of response that we are getting from RE developers, we hope that we'll be able to reach this figure of 3 lakh crore for renewable energy projects in next 5 years only.
You know, ever since you've been talking about zero net zero by 25, market really loves it, and your valuations have actually improved quite a lot from half time to almost 1 time plus. But this change in contribution from your traditional towards more green in the next 3 to 5 years and then longer term by 2030, how will it improve your ROEs and ROAs over the medium term?
We are targeting to keep our asset quality good. We are targeting only good asset quality, and although the margins in renewable energy sector is lower than the conventional generation, but we would like to offset this margin by increasing the volume of our loan portfolio in renewable energy portfolio. Particularly now, other than solar and wind hybrid solutions, we need to have storage solution, because renewable energy is intermittent in nature. In order to have grid stability, we need to have storage solutions. So that's why we are targeting this pump storage hydro projects, battery energy storage projects also. And with the launch of green hydrogen mission, we are now targeting to finance green hydrogen, green ammonia portfolio also. So this will be able to sustain our margin, which is around 2.5 to 2.75%. And net NIM will we are targeting that will be able to sustain at around 3.5%.
Vivek, but just a question, given the fact you're increasing your exposure to renewable and there have been those headlines that keep on coming time and again, that it could be one of the ticking bombs given the fact these PPAs have been signed at very low levels of tariffs and the prices of modules, etc. have been very volatile of late as well. Are you not worried that there could be asset quality issues maybe later in the cycle?
No, we have done a detailed analysis and we are not worried at all. The asset quality is going to be quite good. And we are targeting only those developers which are A-rated.
Just a couple of more questions, Vivek. What's the competition right now from the PSU banks? Because they too are looking at, lending to this space as well. And secondly, there was a lot of expectation of provision write-backs as well with collections coming in from the NCLT, proceedings, etc. as well. What's the update on that?
Yeah, in fact, when this committee on stage asset was formed, headed by the then cabinet secretary in the year 2018, that time we had about 36 stage assets. We have been able to resolve about 17 stage assets in the last 4 to 5 years. And right now, in our book, we have about 17 stage assets, and we are targeting that 9 assets would be able to resolve in the current financial year, and the remaining 10 assets would be resolved in the next financial year. By the year 2025, we hope to have net zero NPA. We had made the provisioning of about 70%, but what we have observed that either these projects are getting resolved under NCLT process or outside NCLT. We are getting a good return. Recovery rate is about 60 to 70% actually. So that's why we are getting write-backs.
So Vivek, on the book, what could be that write-back value?
Write-back value in the current financial year would be at around 4,000 crore, and next year it would be around 7,000 crore.
Okay, so 4,000 crore write-back this year, 7,000 crore coming in for next year as well. And just that word on the competition from the PSU banking space, you're not worried, right? And you're not letting go of your margins on account of that.
Yeah, actually, there's huge space actually as far as the energy transition is taking place. As per an estimate by Central Electricity Authority, the total debt requirement would be to the tune of about 15 lakh to 20 lakh crore only. So there is space for all the PSU banks, other financial institutions. We are targeting about 20% of this market share, which will come in the sphere of green projects.
The cost of borrowing, are you looking at going more global and picking up the foreign bonds, or this inclusion that has happened of the Indian bond in the emerging market index, that is also likely to have an impact on your cost of borrowings at least from next year?
Yes, in fact, in the month of April, we had raised a green bond worth $750 million, and we are looking for other cheaper options because we need to reduce our cost of financing. So we are looking for those green bonds which will be available at less than 7% all-in cost, including the hedging cost. So we'll like to keep a good mix of our bonds, either domestic bond or the external commercial borrowings.
Net on an average, what will be the cost of borrowing by the end of the year?
At the end of Q1, our cost of borrowing was about 7.23%. And our yield was about 9.83%. But by the end of year, our cost of financing, we are targeting to bring it down to about 7%.
Okay, good to hear that, Vivek. Thanks as always for taking the time. Our pleasure speaking with you today. Okay, on that note, we'll slip into a very quick break. When we come back, we'll focus on cement and what are the prospects of that sector.
Let's put the spotlight on cement space. This time, despite of monsoon, cement prices actually edged higher in many regions of the country, and the stock prices on the markets also. We've got Sandeep Ghosh, Managing Director at Birla Corp, and we also have, along with that, Naveen Sehdev, Research Analyst at ICICI Securities, joining us to help us understand the market context of it. Thank you very much, gentlemen, both of you, joining us on the show. Mr. Ghosh, is the demand scenario stripping supplies and also the monsoon situation disruption? that even despite a monsoon, we saw pricing edging higher, at least parts of region in south and many others. What's the scenario like on ground?
See, there are two things. When you talk of monsoon, weather has become very unpredictable nowadays. So August, which is usually affected by monsoon, was a very good month for the cement industry. It saw not high, but close to middle double-digit growth. But September has been a damp now because there has been rains all over the country. And pretty heavy rain, so there has been dislocation. So September, in fact, you might find the volumes to be certainly much lower than August. And compared to last year, also the growth may not be significant at all. So, it's not really the question of demand outstripping supplies. Demand has been healthy, and that's been the projection, which Mr. Saudeo will also say that throughout the year, the industry had predicted, and analysts have predicted about 9 to 10% volume growth. But the issue on prices really is, if you see the prices have remained flat for now almost a year. And that was despite the sharp increases in cost last year post-Ukraine in the fuel costs especially. Now, though fuel costs started normalizing by the end of the third quarter, and it's remained, continued to go down, remain soft. But the industry's other costs went up, which they were not able to pass on at all. And now we are also sitting at the cusp of a time when oil prices are once again beginning to heat up. And as I said, other costs have picked up. So the industry does not have an option but to look at some price correction. Cement industry has always been, I think, it's got the wrong end of the stick, saying that they have sharp price increases. But if you see normalized over a period of time, cement price increase has been extremely modest, if you see in a normalized way. And so if today they don't increase the prices in the coming months, you will have the delivery in terms of profitability and in terms of, what are the investment plans of various companies, you can have pressure there. So I see some correction happening, but it's certainly not going to be a runaway correction.
Mr. Sadev, how are the valuations of these stocks trading at? No price hike for last 1 year and now normalization happening. Are they in attractive zone versus their long-term average?
Have already seen a pretty decent run up. So all the large caps, I think, trade anywhere between 15 to 18 times EV EBITDA. And even the smaller names, I think, trade in excess of 10 to 13 times. So this is very much or slightly higher than their long-term range.
That you like, Naveen, as a recommendation, which is your top bet right now?
So we'll go for pockets where we find value. So rather than a direct exposure, what we are recommending is play the cement story through Grasim, because that's where bulk of the value comes in. So currently, I think the holdco discount is fairly high, almost about 45 to 50%. The other story which backs our positive reco on Grasim is that the standalone entity, which is VSF and Chemicals, is bottomed out. At least in China, we are seeing from the bottom, there is a 5% plus kind of a recovery in both these prices, caustic soda as well as VSF. Cement, as we know, demand continues to remain good, of course. And the fact that pricing sentiment is improving, that should be a good tailwind. And lastly, the paint business is just about to start anytime soon. I mean, in fourth quarter. So that should be a good value unlocking that should happen as they progress successfully into the paint segment. So large caps, we are recommending Grasim, and the mid cap plays, we find JK Cement to be very attractive.
Sandeep, the other leg of the story, right? That's the input costs. I mean, both crude as well as petcoke prices have seen a fair amount of escalation. How do you think that's going to play out on your balance sheets?
This question to me?
Yes, Sandeep, to you.
Yeah. Okay. Now, you see, crude and petcoke prices have firmed up a little, but I don't think it has reached any alarming stages yet. But what I mentioned to you that, since last year, when most companies went into the red in the first second and third quarter, it has not really, the profitability has not gone back to the pre-Ukraine normal. And whereas other costs have, in fact, inched up during this period, and there could be a possibility of, again, fuel costs firming up, because we already see that there is heating up in the international oil market. So cement companies will need correction to get back, the price corrections to get back to a normal profitability, which the market is expecting from them. So that would mean a certain amount of, has to be their price correction. Initially, at the beginning of the year, most analysts had said there'll be volume increase, but not too much of price correction. But I see that changing in the second half of the year. And right now, when some of the stocks which you have, indicated, where you're seeing certain regions, especially the East, had a huge price drop earlier, and now that is getting corrected. So that's why you saw some of the names you put up on the screen I was seeing. Those are the East-based companies who will see higher, profitability correction right now, and therefore I think people like Mr. Saudeo are putting in more confidence in some of those stocks.
Sure. So the Eastern, facing companies are doing a lot better. But for yourself itself, given the demand and the supply dynamics that we talked about, are you on track to achieve that 850 rupee per ton kind of EBITDA?
We are still maintaining that projection, because we see certain developments happening, especially limited to us as well as on the market scenario in the second half. As we all know, people in the cement industry bank a lot on the demand during pre-election season. That would, I think, that volume, that demand is yet to pick up. One should see that will kick in, I guess, from next quarter. And if with that there are price corrections, and then I said there are company-specific, factors. With that, I think we are maintaining our 850 projection. Near about 850 is what we have said.
Are you also maintaining a 15% volume growth kind of guidance, or given that election, the pre-election volumes are going to kick in, it could be 15 to 20%?
I don't think it'll go up that high. No.
But at least 15% then, or even that is looking difficult?
We are fairly stretched on our capacities. Okay, some of our existing units, only place we have to ramp up is a new unit which has come up in Maharashtra, Mukudban. But if you look at our other existing units, some of them are operating at close to 100% capacity. So we are not seeing that sort of a ramp up for us specifically. People who have got spare capacity, who have added on new capacity during the year, they might have, so therefore, some names you have mentioned, they have, I think, headroom for a higher increase if demand supports. But we are quite happy with our, 12 to 15% kind of a growth.
I mean, that's the other thing, right? Although you flagged off that going via the holdco route and via Grasim is the best cement play right now. But just wanted your own perspective on the capex which is lined up for the year or next 2 years ahead, and whether a second round of price hikes, say in the month of October, could be absorbed by the market. Is there enough demand?
Yeah, so because these are two unrelated questions, so I'll take about the pricing part first. So I concur with Sandeepji that almost for over a year, the industry has been reeling under the pressure. In fact, last year was probably one of the worst years for the entire industry, because given the sharp spike in fuel cost, all thanks to the Russia-Ukraine war, they could not really, pass it on to consumers. This year, I think there is definitely a good chance. We've already seen that sort of recovery after a very sharp drop all the way from January to August in the eastern region, especially. September has indeed given a good recovery. And I think the expectation is pretty much ripe for a similar sort of like, recovery even in the southern market. So even in other pockets like north, central, and west, you will see increases happening in the range of 10 to 20 rupees beginning October. So demand is clearly supportive for sure. And I think the environment itself is pretty much conducive for the entire industry to take the price hike in the month of October. Now, how long it sustains is a $1 million question, because historically what we have seen is sharp spikes especially don't last beyond a couple of months, but what it does build up the overall realization base much higher. So it's nonetheless, I'm saying, becomes directionally positive for the sector, so to say, at least from a near-term perspective. On your other question about capacities, so yes, there is indeed a huge capacity built up happening. There is Adani Cement, there is Ultratech who's executing phase 2. I think very soon they'll come up with their phase 3 expansion. There is Shree Cement, which is going all out, and many names. So I think if next year FY25 we are expecting 35 million tons of addition, 26 I think looks pretty promising from even a 50 million ton plus kind of a capacity addition, if all the plans, if companies are talking, have to be executed. So I think from a capacity addition perspective, there is pretty healthy pipeline, and that's where the caution comes in, because this year is pre-election demand. But last time, in let's say, I'll draw your attention to FY20, where the demand after elections was just about flat. FY19 had seen a 13% growth. So I think similar kind of a thing could possibility, because this year the demand is anywhere 11 to 13% growth seems very much possible at an industry level. Next year, if it slows down, then that might require some caution there.
That $1 million question is on the sustainability of both the pricing power and the demand. But Sandeep, just coming back to the discussion with you on the capacity side, you had laid out some big targets of 30 million, 30 MTPA by 2027. Which are the areas you're building up more capacity in, and how are you going to fund this?
See, funding will happen first level organically. We are wanting to keep our debt level, which we have mentioned, at more or less the current level, there. And then our second phase, we'll have to see how it goes to 30 million. We were originally saying 25 million by 2025. We are behind that by about a year or a little more than a year, because our earlier expansion ran into the whole COVID period, and therefore we are coming there. So we have, I wouldn't call our plans conservative, but we have a fairly steady plan. We are not going in for those big numbers which some of the bigger players or even some of our peer group are looking at, because we have to consolidate our profitability. And that's why we are focusing more on what we'll do on the EBITDA delivery, both in per ton basis as well as in absolute terms. And once that comes in, and we have got certain major cost savings planned, and I don't want to dwell too much upon it because we are getting into the sensitive period, but especially say on captive power, in terms of captive coal mines, we'll have one of the highest component of captive coal mines in the industry. So those initiatives are in place. And so we will focus first on getting our profitability up to the levels which we aspire to, and then look at further, need for raising funds or not. But that'll come closer to the time when we have to, take those decisions.
And I'm guessing this profitability improvement is what you're talking through that project Shikhar as well. So what's the update on that? And you were also going to tell me where these capacities are coming.
No, we are, as I told you, our clinkerization capacity will start only in 25-26. Right now, our first phase, what we have to do is we are looking at optimizing our new plant, which is in Maharashtra, and which we are on track in terms of our projections, how we are taking the utilization there up. And then thereby we are trying to optimize our go-to-market, our supply chain for our core market, which remains, as Mr. Sadeo said, essentially central India. We're very strong in UP, we are very strong in Madhya Pradesh, and then aside in Rajasthan, parts of North, we are now, due to Mukutban, we are able to address these markets in a much more comprehensive manner. Because when we look at this entire footprint, which is in the center, we have now got this additional capacity, which is just below the center, from which we can service the lower part of central India, that's large parts of Madhya Pradesh, extending all the way up to South Gujarat, which is a very, very high growth and profitable area, which we were earlier not able to reach from our existing capacities in Chanderia, which is in Chittor. So now all those areas open up, and our existing capacity, which was there in Madhya Pradesh, our Maihar, and then Satna, through which we were supplying, say, south of Madhya Pradesh, that can be utilized much better in our core markets of Uttar Pradesh and central Madhya Pradesh and western Madhya Pradesh. So those give us higher realization. And at the next stage, therefore, we'll have to optimize on that, and we'll go in for grinding units closer to the market. We have certain plans for that, which we have discussed earlier. And once all that happens, I think we'll be in a better position to go for our second line expansion in Maihar, which is what we have talked about from 25-26 onwards. Shikhar is just one of the initiatives. Shikhar, we are looking at about 50 rupees per ton already by the end of this quarter. Will kick in from Shikhar, but there are many other things which are in the pipeline. One of the bigger things which I mentioned to you is our captive coal mines, which are coming on stream. One major one will come on stream by the end of the year, end of this fiscal. We are already, we have Sialgogri, which is near Chhindwara, which is in full stream. And then there'll be further additions to our thing. And we will be, therefore, as I told you earlier, that one of the highest, we'll have the highest component of captive coal through captive coal mines. And if the prices, international coal prices and what you indicated, those go up, then I think that'll give us a competitive edge over many of our peers, even in the same region.
Right. All right, Mr. Ghosh, Mr. Dev, thank you very much for joining us with that take on the sector. But talking of sectors, one sector which is doing phenomenally well, whether you look at the stocks in the market, whether you look at the volume growth which is happening in the industry, or the general sentiment when we speak to large realtors, that is the real estate space. Stocks are doing well. And now there appears to be another policy in the offing which could give a further fillip to the sector. Prashant Thakur of Anarock and Ghulam Zia of Knight Frank are joining us to talk more about that. Gentlemen, good morning. Thank you very much for your time. Ghulam, I'll start with you because, you're wearing a lot of pink this morning and the sector is in a pink of health. And now there seem to be the data at 10-year high. Where is so much of volume growth coming from? What are the triggers? And it appears to be sustaining.
Yes. So to start with, the shift that we have seen in the fortunes of real estate industry on the other side of COVID has been an unbelievable run. The transactions were almost coming to like the industry was in a bad shape during COVID. And on the other side, because of a lot of government interventions on the consumer side, where initially there were huge reductions on stamp duties, etc., and even home loan interest rates came down so heavily. Last couple of quarters only, the home loan interest rates started going up. So except for that period, the volumes were growing unabashed. The recent phase, last 3-4 quarters after the higher home loan interest rates have come about, one segment of the market is the only one which is not doing well, which is affordable to below segment. But the upper end is doing extremely well. And when you talk about numbers, most of the listed players or known developers across the country cater barely to the upper 10% of the demand of the housing requirement. And that is what is worth looking at, because the growth in the industry that you're talking about is happening because of mid to upper end only. And that is, in a way, it is also slightly worrisome, because that may not last long. Sometime you will have to focus on mid to low end, but that said, at least so far the party continues, because mid to upper end is growing like anything, and the transaction volumes are just not coming down in spite of high home loan interest rates. Because on the other side, the wealth creation earlier, whether it was because of good stock performances or good salary rises, and overall the mid to upper end has really thrived, and hence the housing demand has continued. So overall, so far, the demand is continuing, and perhaps next couple of quarters also, we don't see any hurdle for this kind of growth to continue. Back to you.
No hurdle at all in the near term. All right. Shobit, now there is another big scheme in the offering from the government side. We are gathering that almost, Prashant, from the government side, $7.5 billion worth of scheme to give the further fillip to urban middle class. So will this really give a lot of push to this kind of already the sector is in massive momentum? How potential could this be?
See, as Gulam rightly said that there has been a good upsurge in the overall sales. But what we have seen is that while the upper segment is doing quite well, the lower and affordable segment has been kind of lagging behind, and there are a couple of reasons behind it. So while rise in interest rate did not impact the upper and mid-upper too much, the affordable segment got impacted because of interest rate increase, the home loan eligibility of these borrowers came down because most of them work in either unorganized sector or they don't have steady income source. I'm talking about buyers of affordable housing. What also happened was that because of increase in material cost, the cost of overall affordable housing went up. So in my opinion, any subsidy or let's say bringing back this CLSS scheme which gives interest subvention to the buyers of affordable will give a push to this segment as well. And when you combine the already well-doing upper segment and when this lower segment also starts to pick up, I think the overall volume will pick up further. So in my opinion, this move, if it is implemented, I think will definitely give a fillip to the numbers. And in my opinion, with the whole intention of this housing for all was to help the urban poor, the economic weaker section and low income group. And somewhere in this rally of residential sales, we have seen this segment not participating while the other well-off segment is doing well. So in my opinion, this will be a great initiative if it is taken, and overall numbers will get a boost.
Sure. Gulam, I wanted to know the reality because of late we have been seeing a lot of videos, reading a lot of headlines that a new property is launched and within 24 hours, 36 hours, 48 hours, they're completely sold out. Do you think this is largely a marketing gimmick as well? And, these are just the booking names which are later withdrawn? Or there's genuinely that much demand for a lot of these properties that they're getting sold off the shelf?
Is that question to me?
Gulam, yeah, the question is for you.
Okay, well, I would say I would go with mixed bag kind of a feeling because many of these transactions are definitely happening, but on the other side, it's also a kind of a media buzz as well, to create euphoria in the markets. A few of the developers have successfully done what you're indicating. Like earlier, we saw some big names up north and even in western side. We did see in Mumbai and Delhi a lot of such schemes picked up like hotcakes. But that's not something which you can generalize across the market. Number one, the developer has to be really good with good credentials. Number two, the product indeed has to be good. So these two factors coming together, and of course, I can't forget about the pricing. These three things falling together, you do have consumers making a beeline to buy such products. But that, once again, let me caution you, it cannot be generalized because every such project will have at least 10 other projects which will struggle to sell. So overall, while the markets have given very good response to a few of such projects, but it is not a general story. I hope your point is answered well.
Prashant, but what one is witnessing, and please correct me if I'm wrong here, that the demand is actually scaling up only within the luxury as well as the high ticket size or housing segments. Is that really the case? I mean, is that where all the demand and supply as well is happening?
You are right when you say that, we are seeing a lot of action on the top segment. There are a couple of reasons, as I mentioned, that, the interest rate, the home loan rate increase has not impacted the upper segment much. It is the lower strata of the income group that has been impacted because the loan eligibility also comes down. The effect that we are seeing is in 2018, the share of affordable housing in the overall new launches was 48%. Today, it stands at 18%. So somewhere, I think, while the number has picked up, overall number, sales volume and supply volume, it is getting concentrated towards 85 lakhs and above segment. These are, people who work in formal companies. They have a regular stream of income. Even if the home loan goes up, they don't get impacted much. But the real worry is that India is still a housing deficit country. And when you talk about economically weaker classes and low income group, that's where the intention of affordable housing was, the scheme was launched to benefit them. So in my opinion, the talks that we are hearing is that these schemes, CLSA schemes would be relaunched, would help that. And ideally, when the volume picks up in the affordable segment, that's where we see the real number coming up. Because in my opinion, the continuous demand on the luxury side might not be sustainable. It might, be either a result of pent-up demand or let's say a time frame demand. But if you want a sustainable, long-lasting growth for this industry, it has to be an overall participation, and that comes from the bottom of the pyramid.
And the bottom of pyramid is just waiting by to participate as well. Thank you, Prashant, as well as Ghulam, for joining us on that quick take as to where the real estate sector is headed, and more importantly, how long can this euphoria really continue. But time now to slip into a very short break. Don't go anywhere.